Our group assignment 4 for investment management, or our final project. And today we will be analyzing a foundation's fixed income bond portfolio. Today I'll be starting with part 1, task 1. Here we calculated the price, market value, and weight of each bond, and finally we calculated the total market value of all the bonds. Bond A is priced at $99.01 with a market value of $39.6 million and a weight of 20.2%. While Bond B is priced at $106.75 with a market value of $64 million and a weight of 32.67. Bond C is priced at $116.67 with a market value just over $64 million and a total weight of 32.73%. Coming in, Bond D is priced at $94.06 with a market value of $28.22 million and a weight of 14.39%. After adding everything up, the total market value for this portfolio is just over $196 million. Moving to part 1, task 2, we calculated the modified duration, which means a bond's price sensitivity to a 1% change in the interest rates. It tells us how much the bond's price will change in percentage terms, assuming cash flow stays fixed. Here's the modified duration for each bond. Bond A is 2.83 years, while Bond B is 5.99. Bond C is 7.68 years, and Bond D is 14.26. Using a weighted average approach, the foundation's portfolio modified duration is 7.10 years. Part 1, Task 3 asks whether the portfolio complies with the IPS requirement. The IPS states that duration must stay within 0.25 years of 6.2 years, meaning the target range is 5.95 to 6.45 years. Since our current portfolio duration is 7.10 years, we're outside of the allowed range, so an adjustment would be needed. To bring the duration back into the range, we propose 2 strategies. The first strategy would be to buy shorter-term bonds, specifically increasing the position in Bond A, which has the lowest duration. The second choice would be to sell our longer-term bonds, particularly Bond D, which has the highest duration of 14.26 years. For part 1, task 4, to help make duration more relatable, we calculated the dollar duration and the DV01 or dollar value of 01 for each bond. These show how much the bond's values change in dollar terms with interest rate changes. Breaking this down, this is most useful when communicating with stockholders less familiar with the modified duration. The results of this are Bond A has the dollar duration of 2.8 million, while their DV01 is 0.028 million. Bond B dollar duration is 6.39 million, and the DV01 is 0.0639 million. Bond C dollar duration equals 8.96 million, and the DV01 equals 0.0896 million. Dollar duration for Bond D equals 13.41 million, and the DV01 equals 0.1341 million. To find the DV01, all we did was we took the dollar duration and divided it by 100. Finally, in part 1, task 5, we assessed how much the portfolio's value would change if the FOMC raised interest rates by 25 basis points. We chose 25 basis points because this is how they often change their federal fund rates in increments. This is considered a standard and measured policy move in a monetary policy. We calculated the portfolio dollar duration at 7.52 million and the DV01 at 75,192. Using the formula of change in value equals dollar duration times rate change, we got $1.88 million lost. So if the rates rise by 0.25%, the portfolio is expected to lose $1.88 million in market value. This highlights the importance of adjusting duration to mitigate interest rate risk.
We were asked to find the key rate duration to a 30-year 8% coupon treasury or corporate bond from the previous project, and first we have to define what the key rate duration is, which other duration measures assume a parallel shift in the yield curve structure of the yields, but in a key rate duration, you're more looking at changes at a specific yield at a specific time, which is more common in real life, where the curve tends to shift in specific spots rather than just a parallel shift across the whole curve. So the first thing we had to do was calculate the present value using one of the methods prescribed in the last group project. We chose the LW method here, and we calculated the present value of the future cash flows of this bond using the LW method. To do that, you use the similar, you use the present value function on all these cash flows at the year they are going to, and you get the present value of 169.668. This can be considered your PV0, or your current value of the bond. And then to measure the duration, you need to find the key rate duration. You need to find the present value given a 0.25 basis point change in the 2-year yield, in the 5-year yield, and the 10-year yield. So for the 2-year yield, we kept all these similar rates the same besides at the second year, and in the PV minus situation, we subtracted 0.25 basis points. And in the PV plus, we added 0.25 basis points and kept all of their rates the same. And then we did this similar calculation as before and calculated present value of cash flows. And down here at the bottom, we got the PV minus of 169.70 and 169.63 for PV plus. And then we did the same thing for the 5-year. And then, which you can see here, is where we changed the rates at year 5, and then the 10-year, we changed the rates at year 10, and calculated the PV0 or PV minus and the PV plus for those. And so then in order to find the key rate duration, you use the PV minus subtracted by the PV plus over 2 times the change in rate time, or 2 times the change in rate times the PV0. And so so that gives you these functions here. So this is the PV minus the PV plus on top for all 3, and then the bottom here is just the rate change, which is 0.0025 times 2, because it's going in both directions, and then times the PV0, which gives you the product. And then underneath that, you divided the PV minus and the PV plus divided by that product, and you get the 2-year key rate duration, the 5-year key rate duration, and the 10-year key rate duration. You notice that the key rate duration for the 2-year is 0.08. So for every 1% or 100 basis point change in the 10-year or the 2-year duration, you'll get a 0.08% change in the present value of the bond. And then similarly for the 5-year, you'll get for every 1% change in the 5-year rate, you'll get a 0.18% change in the price of the bond. And same for the 10-year. And you notice that as for the 2-year, the change, the duration, key rate duration is lower, and then as you go to the 5-year, it's in the middle, and then the 10-year is the largest. This could be explained by the fact that when you're calculating the present value of the cash flow, you put it to the multiple or the power of the period. So for the 10-year period, you're changing these cash flows 10 years out, and in this function, you're putting it to the 10th power. But in the 2-year, you're only putting it to the 2nd power. So the effects of this is going to be exponentially more than the effects of the 2-year change. And so the further out the key rate change, the greater the effect on the current price of the bond, just because those cash flows are
the discount factor is much greater between the PV minus and the PV plus because you're exponentially growing the discount factor.
So yeah, that's why you see this 10-year key rate duration being higher.